Good morning, everyone. Thanks for joining the weekly research morning call. Today, we'll be having a recap on Singapore strategy and stock picks, as well as Phillip US Power 5 and the Euro technical pause. And so without further ado, I'll hand over to John for Phillip US Power 5.
Yeah, thanks, man. Good morning, everyone. So we'll just run through the S&P 500's performance for September. The S&P was up 2%. And this was mainly led by utilities as well as consumer discretionary. A lot of it was mainly because of the 50 basis points rate cut. We look at the top gainers over here, see Las Vegas Sands as well as Tesla. Those are both discretionary companies up there. As well as actually some of your utilities, Constellation as well as Vernova Inc. When you look at the top losers, you've got Rivian, you've got Global Foundries, you've got kind of a whole mix of companies as the top losers. The next slide, please. Yeah, when it comes to our Power 5 model portfolio, essentially it's just 5 of the companies that we have coverage on and kind of put in the portfolio. There are no changes, so 4 of them are big tech companies, while the last one, or the odd one out, is actually JP Morgan. The performance for the month was up 2.2%, so we beat the S&P 500 after 2 months of essentially declines. So year to date, the portfolio is up 42%, far exceeding the S&P 500's gain of almost 21%. Yeah, so that's all for me. I'll hand it over to Zane for some technical analysis. Thank you.
Thanks, John. I'll move on to the technicals. Next up is so for S&P 500, it's just been consolidating sideways currently. But however, it's still holding above the breakout of 5,670. So should this continue, we are still likely to see new highs going ahead, with immediate resistance at 5,760 to 5,850 area, while support is likely to be at 5,670 to 5,720 area. Next slide. And next one, we have ETF money for September, titled S&P 500 to extend bullish momentum. So just to review the September performance of the different asset classes, all of the ETFs were in the green. Less oil, which was down 5.1%. The top gainer was Hang Seng, which was up 17.4%. In terms of the current trends, S&P 500, US Treasury bonds, gold, Singapore equities, and Hang Seng Index are in an uptrend, while oil and Bitcoin are in a downtrend. As for our outlook for October, where we expect S&P 500 to extend its bullish momentum, while most of the asset classes could be in a sideways consolidation, and Bitcoin could continue its pullback in this downtrend channel. Next slide. So first, I'll look at the S&P 500 ETF VOO. We still continue to see bullish momentum with a breakout of the $517 horizontal resistance breakout recently. So could still see the bullish momentum extend to October. Next slide. The next one is the IEF Treasury Bond ETF. So for this, it hit the swing high resistance at about $99. So we're currently seeing a bit of a pullback. So for October, we could see a bit of a sideways consolidation with support around the $96 level. Next slide. The next one is the Gold Mini Shares Trust GLTM. So for this, momentum is still strong. Price is still above the trendline resistance. However, we could see a bit of a sideways consolidation given that it's at this kind of resistance level currently. Next slide. The next one for the oil and gas production ETF SOP. For this, we've seen a bit of a momentum coming back since it broke above the descending wedge formation after it tested the support, which is about $324. However, there's still likely to be some resistance going ahead around the 141, 142 level. So we could see a bit of a sideways consolidation. Next slide. The next one for the Bitcoin strategy ETF is still currently trading within this downtrend channel. So I think likely to continue this trend as we are currently near the channel resistance. We could see a bit of a pullback going ahead to October, which could retest for $16 to $17 levels. Next slide. The next one is for Singapore Equities ETF, ES3. For ES3, we can see the momentum is still very strong. We have a breakout above the $3.50 horizontal resistance. Currently just doing a bit of a consolidation. So I think we could still see the momentum continue ahead with a bit of a consolidation in the near term. Next slide. For Hang Seng, very, very strong momentum these past 2 weeks. Currently it's about, it hit the $83 previous support level, which could act as a bit of a resistance currently. So we could see a bit of a slight consolidation in the month ahead after these strong gains. Next slide. Next one is we have our Thai SDR money for September, titled Delta Electronics to Extend Gains. So review of September's performance for the different SDRs. All of them except one were in the green. Top gainer was Gulf Energy, which was up 13%. PTT was the one in the red, which was down about 7%. In terms of their current trends, Airports of Thailand and CPO are in the range consolidation. PTT and Siam Cement are in a downtrend, while the remaining SDRs are in an uptrend. For our outlook for October, we expect most of the SDRs to consolidate sideways. PTT and Kasikorn Bank could do a slight pullback, while Delta Electronics could continue to trend higher in October. Next slide. So first up for Airports of Thailand, you see price did a slight rebound towards the downtrend resistance line again. However, at these levels, at about 65 baht level, we could see a bit of a resistance coming. So I think we still could see some sideways consolidation going ahead with support around 60 baht in October. Next slide. Next one, the CPO. So for CPO, we saw a breakout above the bearish flag resistance in blue. But however, there's some it just hit a previous swing high resistance of 66 to 68 baht area over there. So currently doing a bit of sideways consolidation. I think price would just continue to trade sideways in October. Next slide. Okay, next one for PET. PET, I think price is still showing some weakness in the near term with a breakdown recently below the 136, 137 baht support level. Currently doing a bit of retest, but I think momentum should still be quite weak ahead, given the overall downtrend since March to April this year. So yeah, we could still see maybe price do a bit of pullback going ahead to test like a bit of a lower support levels at 125, 100 to about 130 baht area. Next slide. Okay, next one for Gulf Energy, top gainer for in September. So you can see the momentum is very strong after breakout of the downtrend channel resistance. Price also managed to break above the previous swing high resistance around 55 to 56 baht area. So currently seeing some new highs, we could possibly see some consolidation going ahead after these strong gains. Yeah. Next slide. Next one for Kasikorn Bank, also managed to retest a previous swing high resistance about at 159 baht area. Currently, we are seeing a bit of a pullback from that resistance. So I think we could still see maybe some slight pullback in the month ahead to retest some a lower previous resistance breakout level, which is around 144 to 148 baht area. Next slide. Next one is Siam Cement. Siam Cement continue its recovery, although it's still overall in the downtrend. So currently we enter back into this downtrend channel. We are seeing a bit of a sideways consolidation. So I think yeah, we could still see maybe some sideways going ahead, some resistance at about 250 to 265 baht area. Next slide. Next one for Advanced Depot Service, also very strong momentum. Price traded above the trendline resistance and then managed to hit the projected target level of the cup and handle formation breakout. So currently we are seeing a bit of a sideways consolidation for about 3 to 4 weeks. I think we could still see this consolidation go on for a while in October. Next slide. And last but not least, Delta Electronics, I think currently is building a sideways consolidation. However, I think momentum is still strong. We're still seeing a bit of a higher highs and higher lows continue to form. So I think we could see the breakout of this consolidation above the 108 resistance level to go on to test the previous triple top resistance around 114 to 118 bar area. Next slide. Next one, we have a technical buy for Thai Beverage at 53 cents. Take profit levels at 56.5 cents and 58 cents respectively. Stop loss at 51 cents, and last close was 52 cents on Friday. So looking at the chart, there was a breakout above the 52 cents inverse head and shoulders formation neckline resistance, and price continued to hold above it. This was after it formed a higher low support at 47 cents after a breakdown below it in July. Then subsequently we saw a recovery and price has continued to remain above it. This is coupled with increasing momentum on the MACD, where the MACD has continued to hold above the zero line as well. So overall, I think we could see a continued bullish reversal for Thai Beverage, where price could rebound further towards these two take profit levels. Next slide. Then the summary for our trades initiated, currently Thai Bev is slightly down about 1.8%. Yeah. Then next slide. Yeah. So we had our fourth quarter Singapore Strategy and Stock Picks event. So these are just our summary. First up, outlook of Singapore market. Next slide. Yeah. So from looking at from a TA perspective, this is the ES3 ETF, STI ETFs. We're still seeing strong bullish momentum. Above price broke out above 350 resistance. So for fourth quarter, I think we could still see some room for upside, where price will trade closer towards 380, which is about 4.3% upside from current levels. Next slide. Then for our large cap pick, we have City Development, CDL. Next slide. And for CDL, price has been trending down since the start of this year, but however, we see price starting to base out recently, forming an inverse head and shoulders formation neckline resistance at $5.55, which is coincidentally a previous range support level as well. So if price is managed to break out above this level, confirming a downtrend resistance line as well, we could see price rally towards $6.08 level, which was a previous range resistance, and this is confirmed the inverse head and shoulders target, the breakout projected target level as well. Next slide. And for our mid-cap pick, we have Food Empire. So for Food Empire, yeah, price has been trending down since about March this year. However, price we can see that it's starting to base out recently since July. Support has held at 96 cents and resistance has been at $1.01. However, recently we noticed that price has managed to break out this range consolidation, coming after a breakout of a downward resistance line as well. So we could see a recovery in terms of the share price to reverse upwards towards $1.15, a previous horizontal resistance level in May. So that would represent about 11.6% upside from current levels. Next slide. Yeah. So that's it from me. I'll hand over time to Glenn to talk about the investment themes. Thanks.
Thanks, Zin. Yeah, so for the first investment, the theme and I guess the sector we're looking at will be the banking sector. We'll just do this quick second quarter results recap. For the second quarter, year-on-year wise, we see that both the NIMs were on a decline. So it's a bit low to mid single digit basis point decline. And this is to be expected, as the cost of funds start to creep up for the banks and, their yield is not really increasing as much. So this decline is expected. However, the net interest income was surprisingly still strong. And I'll explain a little bit later on how the banks are able to still improve their net interest income even though NIMs have dropped. What was the growth driver for the banks, and also what we do expect the growth driver to be moving forward would be the fees and commissions. It has increased quite well, high single digit to double digit growth for all three banks. And this resulted in their PATMI or earnings also, showing quite positive growth. However, if you look at OCBC here in the middle, it's a bit of an outlier compared to the other two. It was up 14%, and this is mainly due to their having an insurance, a separate insurance arm that they did quite well. So they were also up double-digit figures for the insurance arm, and this boosted their PATMI by quite a bit. Lastly, I think I'd like to point out at the bottom of the table here, you see the Common Equity Tier 1, CT Tier 1. It's still above their optimal operating range of 12.5 to 13.5%. You know, it's quite a bit above, except for UOB, I guess they're in the range. So it's still quite a bit above. So there's still some room and some space, you know, for DBS and OCBC to possibly pay out slightly higher dividends. Although I think it's quite unlikely that they will do it, but it's just a possibility. Now moving on to the next slide. Yeah, the next slide we'll be looking firstly, you know, at the net interest margins and net interest income. As I said earlier, you know, I'll be explaining how they've actually managed to increase net interest income, even though net interest margins have flattened. So as we can see, the two lines here, the net interest margins do follow the the interest rates quite closely. This is the 3-month SORA, you know, and as the interest rates have started to decline slowly, and with more declines in the future, right, we should expect the net interest margins will decline equally, right? But we do feel that the banks have protected their net interest margins and as well as their net interest income by putting a lot of their excess deposits into interest earning assets such as securities, as treasuries. You know, the other way that they earn money is to put it back to loans, but as loans isn't growing as fast, they are securing and locking down these their net interest margins by putting it into interest earning assets. So I think they said that they have predicted it, so they managed to protect it all the way until the first half of 2025, so next year. So it's about 9 months of net interest margins. Hence, we are expecting net interest margins to be around the 2.1% range for the end of this year as well as into going into next year. So, you know, if net interest margins and net interest income is rather flat, what do we expect the banks to be able to continue growing their earnings? And there are 3 points that I'd like to bring up. So moving on to the next slide. Yep, the first point being that their fee income is structurally driving their earnings. So we can see in this blue bar here, that's their AUM, assets under management, has been growing steadily, right? You know, throughout ever since the end of 2022, sorry. But however, what we have not seen is that the fee income has not really followed suit. So there were some quarters where fee income was actually flat, right? Some halves and quarters where fee income was flat year on year, although AUM grew. And this is mainly due to the customers and investors putting their AUM or their funds into low margin products such as fixed deposits. This was during the high interest rate environment where they were able to get, like, you know, up to 4% kind of interest on their assets. However, now it's a different story. The fixed deposit rates have also declined, and investors are having more of a risk-on sentiment, and they're putting it back into investment wealth products. Hence, we have seen this double-digit growth in fee income for the last, I think, 2 or 3 quarters. And I think we do expect it to continue going into the rest of the year as well as into next year. So we're expecting this double-digit fee income boost for the banks. Now, moving on to the next slide, the next pointer is that the trading income surge is possible for the banks as well. So we do feel that there's some, if there's higher volatility, we're using the VIX here, which is the volatility index, against the trading income. So recently, what happened in the last quarter was that there was quite a bit of volatility due to the Japan carry trade. Hence, we do expect that the banks will be able to benefit from this, and be able to get a even higher trading income going into the 4th quarter of the year, especially in the 3rd quarter of the year. Yeah. Now moving on to the last point, the 3rd point is that the loans growth recovery has started, even though rates were still quite high. So we only have data on up till the August of this year. So we don't really have any data of when the rates have kicked in, but we do see some positivity. The last 2 months that we have, which is July and August, loans growth have been the 21-month high, even though rates were still maintained at their high levels, right? So there's some positivity going into the rate cut era where we see rates declining, and we could possibly see loans growth surpass this low single-digit guidance that the banks have. So we could possibly see mid-single-digit growth nearing the end of the year or even into next year. Yeah, the positives, the strong points we see in loans Housing loans have been doing well, but I think we could see a pick back up in the business loans. Now moving to the next slide. Yeah, our pick for the banks would be UOB. So it's not that DBS and OCBC aren't good, but we believe that UOB will be able to benefit the most from the rate cuts. Firstly, because they have this very large portion of their deposits into fixed deposits, and they were also the first to increase their fixed deposit rates. They were very aggressive trying to garner deposits a few years ago, but now they are able to cut it back down, and this will improve their cost of funds, their funding costs as well, and this will sort of help to maintain their net interest margins. Also, I put a pointer here that 99% of their deposits are actually maturing within 1 year. So we could possibly see a lot of this repricing when the rates have when the fixed deposits have started to mature. Secondly, they also have a very small presence in China as compared to the other two banks. The other two, DBS and OCBC, have around, I think, 20% of their portfolio in Greater China and Hong Kong. But whereas UOB only has about 5 to 10% in China and in Hong Kong. So if you are uncertain about that environment, then UOB would definitely be the best play. And last but not least, UOB is also pushing for a shift towards the fee income or non-interest income to sort of grow their earnings, right? Previously, they were very focused and heavily focused on net interest income, especially the SME sector and loans. But now they're realizing that they need to shift more towards the fee income to be able to continue to grow. And hence, that's why they did the Citi acquisition. And they're also very heavily concentrating on the ASEAN 4 regions, because Singapore to them is a little bit too saturated and it's a bit hard to really see a lot of growth. Hence, they're moving to these outside of Singapore, especially, but still nearby in the ASEAN region to continue to grow. We do have an accumulate rating with a target price of $34.90 for UOB. So that's all I have for the banks. I'll hand it over to Darren for the REITs. Thank you.
Yeah, so for the REITs, this is the first half performance of all the REITs. So you notice that most of the REITs are still at a negative year-on-year DPU growth. So there were some to manage some DPU growth like CICT because of some cost savings, FEHT because they paid out some previous distribution gains or divestment gains, and Liberty Industrial Trust. You see at the bottom end, most of the REITs still quite weak in the year-on-year DPU kind of growth, but it's negative growth. So Prime US REIT specifically, they are down 92% because they paid only 10% of their distributable income. Lendlease Global REIT, so there are some one of the buildings at Sky Complex is vacant, so that's why the MPI is down 7.2%. But DPU is also down because of higher interest expense. Elite UK REIT also higher interest expense at 40%. Suntec REIT also and such. Yeah, so basically all of the REITs are still being hurt by year-on-year increases in finance costs. But going forward, we think that with interest rates really coming down in most countries worldwide. So next year, we expect interest expense to be lower year-on-year, and as a result, we can expect a higher DPU growth, especially if MPI continues to improve for most of the REITs. Yeah, so how interest rates benefit from how REITs benefit from lower interest rates? Basically, there are 4 reasons. So lower finance costs, higher portfolio valuations, higher asset valuations, transaction volume also start to pick up with lower interest rates, and as well as the dividend yield spread will be more attractive as the 10-year Singapore government savings bond yield starts to fall. Yeah, so on the right column, the green column, basically there's a percentage of loans that are fixed. So basically in the current market conditions, the lower the percentage of loans fixed, the better, as you can benefit faster from the interest rate cuts. So it is color scaled. So green, like FEHT is 35.9%. So that's the lowest in the column here. It scales all the way towards white, where like a lot of the bigger cap REITs are about 80% hedged. So another thing to note is also the tenor of the loans that are fixed. So if let's say the hedge percentage is high, coupled with a long tenor of the hedge, so it basically just means that the REITs will take a longer time to benefit from lower interest rate and interest rate cuts. Yeah, next slide, please. Yeah, so this chart is the Fed funds rate versus the Singapore REITs index. So basically, it shows the S-REIT index performance in as compared to the Fed funds rate. So in the blue boxes there, we notice that during the last interest rate cut during the cycle, the REITs managed to rally. And in those two situations prior, when interest rates peaked, the REITs somehow managed to rally as well. So, but in the current market, you see that when interest rate peaked, the market kind of priced in the higher interest expense as well. So DPU expectations all fell, and as a result, the REIT share price performance wasn't too good in 2024. So that is also why we think that the REITs can rally, because the market previously already priced in the fact that high interest expense will erode DPU. But in the previous two situations, like I mentioned earlier, yeah, the market somehow continues to rally despite the high interest expense. So we think the market didn't really price in the fact that that would affect DPU. So yeah, that is what our stance for this chart. Yeah, next slide, please. And this is the valuations for the S-REITs index. So as we can see here in this chart, it is trading now at around COVID-19 lows. So that is despite the recent rally over the past 3 months, the REITs rallied like over 10%. So despite that, REITs are still trading at historical below averages, like minus 0.8 times price to NAV, or rather 0.8 times price to book. And right now it's about 0.92 price to NAV. So this is below historical averages, and we think there is still room for it to recover back towards the historical average of about 1.03 times. Yeah, next slide, please. Yeah, so this is the 10-year dividend yield spread. So you see the line chart there. The line basically just means how much investors are being compensated over the risk-free rate or the 10-year Singapore government savings bond yield. So right now it is 3.4%. So with the 10-year Singapore government savings bond, you expect that to continue to fall, especially with interest rate cuts, as well as the fact that you take a look at the shaded region here is the forward dividend yield. So forward dividend yield, we expect it to increase, mainly because of the like I mentioned, the lower interest rate next year. That will help to increase the absolute value of the dividends. So you're assuming constant share price, basically the forward dividend yield will increase, and with increasing forward dividend yield and a lower 10-year Singapore government savings bond yield, basically the S-REIT index, the yield spread will continue to increase. So we think this will widen interest rates get cut. Yeah, next slide, please. Yeah, so we move on towards our stock picks. So we have, first of all, we have Cromwell European REIT. So Cromwell European REIT, basically they're still paying a very high yield despite the recent run on share price. So after the first half results, the share price was 130, and now it's already ran to about 160. And despite that, based on 160, and based on the fact that the DPU for FY24 is expected to fall from 15 cents to 13 cents, but that's mainly because of the fact that they've divested many assets, and the absence of contribution from these assets basically will affect the DPU. So despite all that, at around 14 cents, Cromwell is still paying an 8.5% yield. So we think that's very attractive. And also they've managed to maintain their portfolio occupancy around 95% despite a lot of headwinds. Like they managed to survive COVID, and they're so resilient, they survived the war. So all this just shows how resilient Cromwell is. And yeah, that's why we like Cromwell. And the biggest point for us is that Cromwell is still paying 8.5% yield despite the rally. So we think this has a real plus for us. Yeah, next slide, please. And next we have CLI. So CLI is not exactly a REIT, but it's the sponsor to a lot of the CapitaLand REITs. Yeah, so CLI basically they have two different income streams. One is the FRB, so there is a fee-related business income, as well as the next one is REIB, the real estate investment business. So FRB is they earn fees from the management of the listed platforms, as well as the private funds, as well as commercial management and lodging management. So that is the FRB business. And the REIB business, the real estate investment business, basically is CLI earning from the balance sheet stakes of the listed REITs, as well as the balance sheet assets. So going forward with lower interest rates, we expect event-driven fees to start to pick up, so that will help to benefit the fee-related business under both the private funds as well as the listed platform. So we've seen it pick up from the divestment of Ion at the start of September, as well as the divestment of Lift Funan to Class. So that those two will help to generate some event-driven fees there. So we expect some good numbers in the third quarter this year for event-driven fees under the FRB business. And for the REIB, they also they plan to shrink the business to divest out the IIB assets, balance sheet assets into the funds. So that will help to, with more FUM, that will also help to increase the FRB revenue. So they target a 10% growth in FRB every year, year-on-year growth going forward. So right now, they have set a target to double the FUM to about 200 billion by 2028. So right now, it's after the divestment of Ion and Life Funan, the deployed funds under management will be around 93 billion. Yeah, so that is why we like CLI, basically because of the recurring fee business, which is very stable income for them. Yeah, and on top of that, they're also paying a solid yield of about 4+%, despite the potential for capital appreciation. That's why we like CLI. Yeah, so that's all for me. I'll hand over the time to Emma to talk more about some of the REITs. Thanks.
Yeah, thank you, Darren. So we like OIE REIT mainly because of its attractive valuation. OIE REIT just obtained investment grade rating earlier this year and refinanced some of its debt at historically low rate. Yeah, so here's a table to show a few of the metrics of the non-investment grade REITs in Singapore. Like compared to others, OIE REIT has relatively healthy gearing of 38.7%. And also very attractive dividend yield of 5.8%, which is above average. And the most importantly is trading at a very attractive discount of the more than 50% discount to its net asset value. And pre-pandemic, they used to trade at 0.8 times price to NAV. And also more than 90% of the income is generated from the AAA rated Singapore asset. And 70% of the revenue is generated from office and retail sector, and they managed to secure 11.7% and 28.4% respectively in terms of rental reversion for office and retail in first half 24. And we believe Singapore side will continue to hold up well and generate around rental reversion at the teens. Upside is expected to come from the hotel side. Although ADR has shown slight moderation from the peak last year, but we do believe occupancy rate for both hotels, Hilton and Crown Plaza, would hold up well since they cater towards the business travelers. And we forecast RevPAR to grow by 11% for Hilton in FY24, since due to a series of MICE events and also the concerts in second half 24. And the downside will be protected by the master lease agreement, which ensure a minimum 67.5 million. However, again, we do expect DPU to drop marginally in FY24 due to the increasing financing cost, and it will stabilize from next year onwards. And for Sesser, Sesser is a high dividend yield play. It's currently trading at FY24 dividend yield of 8.7% and also price to NAV of 0.85 times. They have 4 outlet malls in China, and we expect FY24 earnings will be benefited from the continuous aggressive promotional events. And also their very clear value proposition of value for money products, especially riding on the consumption downgrade trend in China. And we expect sales to increase by 7% year-on-year, despite the high base last year. And Sesser is also planned to increase its proportion of the onshore loan, since LPR is on the downward trajectory. And currently, onshore debt accounted for around 53% of the total borrowing. And cost of borrowing decreased by 0.3% in first half 24. Because of the strategy, and we expect borrowing costs will continue to decrease, and Sesser may be the first REIT to recover from the interest rate headwind. And moving on to Suntec REIT. We like Suntec REIT again because of its pretty attractive valuation. Yeah, as shown on the graph, although the share price rallied last month, but Suntec is still trading at pretty steep discount of 40% discount to its net asset value, which is very much below the average S rate of 0.9 times price to NAV. FY24 earnings will be supported by the resilient retail rental reversion, and we anticipate retail rental reversion to be held at the high teens and office to be around low teens in FY24. And Suntec is also committed to its 100 million divestment of its strata units and intend to use all the proceeds to pay down the debt with a target gearing of below 40% by the year end. So far, they have successfully divested 31.5 million, with price 27% above its book value. And Suntec REIT also has the second lowest portion of the fixed rate debt, which was 55%. And we believe they'll be benefited the most from the rate cut, with 100 basis point rate cut could potentially raise DPU in FY25 by 10%. And moving on to China Aviation Oil. So CAO is the largest physical jet fuel purchaser in Asia Pacific, and it also plays a very important role in China's civil aviation industry. And profit for CAO mainly comes from two parts. First one is from its associates. CAO owns 33% of the stake in Shanghai Pudong International Airport, and that is the second largest international airport in China. They are basically the monopoly here since all the aircraft departure and takeoff in Shanghai Pudong International Airport will be supplied by CAO. And post-pandemic, profit from associates accounted for more than 70% of the group's profit. And as shown on the graph, with the recovery of international flights, the traffic increased by more than 200% year to date, and profit from associates increased by 180% year on year in first half 24. So we believe profit from associates will increase at least by 50% on a whole year basis. So from 13 million last year to 44 million this year. And apart from profit from associates, they also supply jet fuel globally, especially in China, since China is one of the major oil exporters and still on the recovery phase. So we believe this should support another 30% of the group's profit. And apart from the very visible earnings, CAO also has pretty attractive valuation. Currently, they hold 306 million cash in hand, and cash alone is able to make up about 50% of the market cap. And they also have forward PE of 7 times with EV over EBITDA of 3 times. Yeah, so we believe CAO is very attractive. And moving on to the recent initiation, we initiated Zixin with a buy recommendation and a target price of $0.05. There are a lot of things to buy in China, but why we initiated Zixin essentially was because Chinese government has been advocating food securities by allocating lands and giving subsidies, such as warehouse and facilities. Yeah, so as a result, we believe sales will increase by 70% for fresh sweet potato and also 30% for processed sweet potato products. And as a result, we believe PATMI, as shown on the graph, will at least double this year to 30.9 million. And Zixin has also been actively introducing other revenue sources. As Chinese government is advocating food securities, so they aim to lower the usage of soya bean in animal feed from 40% to 13% by the year end. Yeah, with sweet potato as a key substitute. And we expect revenue to kick in from fourth quarter this financial year and generate around 1.7 million in terms of profit next year. And for the last country is SETS. We just upgraded SETS to a buy, and we expect FY25 earnings to increase by 8%, supported by various contract repricing and also increasing cargo demand. So SETS has just successfully repriced one of its major customer, which is SIA, and accounted for 70% of the FY24 revenue. The new contract will take effect from second quarter 25, and we expect at least 5% rise, generating around 45 million in revenue. Therefore, we do expect result for the upcoming quarter to be exceptional, since repricing for SIA will be taken effect. And additionally, SETS also fully capitalized on the recovery tailwind of the airline industry, and also they have benefited from the spillover effect from the Red Sea conflict. And because of Red Sea conflict, a lot of the time-sensitive products has been redirected from the sea into the air. And as a result, cargo volume increased by 19% year-on-year in first quarter 25. And we expect SETS will be continue to outperform the industry average in FY25, with volume expected to increase by 15% year-on-year for its cargo volume. Yeah, that's all for me. I'll hand over to Paul for Oiltek.
Yeah, thanks, Bill. Just move on to some of our other stock picks. And apologies if those have already seen all this, because we usually will continue on the Monday if the SSP was on the Saturday. So the next one we like is Oiltek. So Oiltek, they help produce facilities, oil refineries, palm oil fractionization, biodiesel plants. So the last 3 years, we can see that the order book has grown about 50% per annum. We are also looking forward to them penetrating into the sustainable aviation oil fuel market. So or call it SAF. So SAF is basically using either these days are using cooking oil, but probably they can move on to palm oil effluent or palm oil waste to be used in cooking oil. To be used in SAF or a substitute for jet fuel. Right now, the industry is about 600 million liters. The expectations is about 23 billion by 2030, which is a 40-fold increase. The other thing that we hope from the SAF is that it will move them away from just a project business to also include some recurrent revenue into the business. So we have a buy with a 70% target price. Next slide. Okay, for this, so for this, I think no stranger. Apologies for the background noise. So we still like it. We think the third quarter numbers should be very strong. Mainly because of the new acquisition they did, CMAC. So that particular company does exceptionally well during festive season when there are disruptions to travel. The other drivers to earnings is the UK bus contracting. It used to be 2%. It's currently providing 2 to 3% margins, but all the new contracts are hitting either high teens or 20% because competitors are leaving. Chinese taxi will still do well because that is basically a pure rental business, and when you do rental right hire in China, you need a license. There is no passenger risk because it's pure licensing, and the fleet continues to grow back to pre-pandemic levels, about I think 11,000 taxis. And then in Singapore, you still have growth. First half was 40%. We're still looking at maybe 15-20% in the second half, mainly coming from the higher taxi commission higher taxi commissions that they are charging on the taxis, of course, and also from the higher fares that the taxis are providing. Sorry, this is not taxi commission. This is the Zig commission. Sorry. Next slide. For ST Engineering, they always so we still have a buy. We still like it. We think earnings was slightly disappointing in the first half, mainly because they didn't have any aircraft sales. But in the second half, the drivers for them continues to be defense. So defense, you get the base load defense contract from the Singapore government, similar to food security. You need defense security in the event of wartime. The authorities will definitely need to rely. You can't rely on foreign countries to come and help you on defense. So that's why they would usually get a captive demand of the Singapore defense budget. What is the growth driver now is exports. So they're exporting more defense products, or like a better word, like a 40mm howitzers, shells. So these are some of the things that they're starting to export, and those are higher margins. And the next big driver, earnings driver for them is aviation. So I don't have it on the chart here. This is purely for order book. But globally, aircrafts are growing about 11% this year, or in the Asia Pacific about 14%. This will benefit ST Engineering because they will do the MRO. And of course, the other thing they do is some of the Airbus engine parts. But that is structurally strong, but maybe in the near term, because Airbus is having some delay, so that might be affected in the near term. But these are the two main growth drivers for them. And the third one will be TransCore, which is so-called the ERP globally. That's urban transport. That's a bit longer term. The only weakness they have is the satellite business because they're actually competing against SpaceX or Elon Musk SpaceX. So that's the one division that's still weak, but we still think the other two will drive growth in the second half. Next slide. Move on to Valuetronics. I think no stranger, it's a contract manufacturer based out of China, but they move most of the facilities now to Vietnam. The market cap is about 300 million, but the amount of cash they have is 200. They continue to buy back shares with committed of 60 million shares they're committed to buy back 60 million Hong Kong dollars, sorry, yeah. So about 30 million Sing. Why the valuations is so cheap, but 2 to 3 times cash flow, is because if you see the blue line, revenue has been declining the last 5 years. But we do expect to rebound. I think the second half of last year results was slightly disappointing, so that's why the share price didn't react. But we think first half should do better with the 4 new customers that they mentioned, and they rarely distinguish major customers unless they are really significant. So we think first half should rebound, and we should see the results coming up in November of this year. Their September results, first half September. They pay like 5% year, and they're doing share buybacks. Next slide. Move on to Pacific Radiance. We just initiated 2 weeks ago, I think, or maybe a week ago. They are basically offshore support vessel operator. You can be accommodation barge or your AHTS. If you recall, this was the hype in 2014, 2015. So since then, they had to do a major restructuring. I think they're one of the few companies that survived the downturn, although you can see all the losses here, 180 million, because they had to make write-offs, make losses. 2022 was the milestone where they had to 600 million debt that they had. They restructured. 200 was from vessels, another 200 plus was debt forgiveness. Some were converted to shares, but these are probably like 50 cents per share at the current price. So right now they did a rights issue. They are in net cash position now. So the two main growth drivers is they only have 1 vessel, but they're growing it up to 3 vessels. So that will contribute to the around 7 million profit in 2025 US dollar, together with the 2 new vessels that they're going to build in their shipyard in Pandan. But for me, it's the longer term trajectory. I think this company at the peak operated almost 40 vessels. Of course, they're not going to hit 40, but for us, we know that if you still assume that this sector will do well, which we think it will because of the lack of supply, I think on order, OSVs are only like 3% of the global fleet. So we think that trajectory of higher charter risk is intact, and it's just for them to continue to build and include more vessels and grow. The third driver will be the Logindo associates that they have, which is totally written off. There's like 40 vessels there. So the debt has also been restructured, and they are looking to probably sell some of the assets or either deploy them in international waters. For us, we just include their proportionate 32.4% stake in Logindo market cap into our valuations of 6 cents. Next slide. So for medium-term momentum, basically is another word for saying that we don't think there's anything interesting in the very near term operationally. So next slide. So for Semiconductor Industries, since the disposal, sorry for the typo at the bottom, but since the disposal of Sembcorp Marine, you notice that in FY22 earnings jumped very strongly, mainly in conjunction with the Russia-Ukraine war. They had excess gas, and then they managed to sell that. And of course, 2023 was also the jump in spot prices. But since then, because they have two main business, which is the gas-powered electricity power plants, and the second business is renewables, like your solar and wind. So for the gas-powered power plants, about 80% of the capacity has been fixed. So the good thing is stable, but the negative is that there isn't going to be huge growth. So the main growth will be renewables. So as the title suggests, we are waiting for them to build up the renewables out of India and out of China. That is growing probably 20%. FY24, you'll see the earnings is down mainly because in the first half, some of the power plants were doing scheduled maintenance, and then they didn't have the big, I think 50 million or 60 million of spot gains that they had last year. That means because of the electricity spot market. So the growth will be gradual, and that's why we are a bit, so this is more a longer term trajectory, because we think the growth will be unexciting, at least for the next one, for second half, but the recovery will be more 2025 onwards. Next slide. So for Keppel Corp, operationally it's not exciting because the earnings was down this year in the first half, mainly because they don't have property development sales. So there are two parts of the story for Keppel Corp. First will be the divestments. Of course, there can be M1 consolidation. The next one will be selling of infrastructure of hotel. But the big one is REITco vendor notes. So why is this called vendor notes? Is because after they sell the assets to the buyer, the buyer didn't pay them, but gave them these notes. It's like IOU, you know, like you sell your house, then the buyer didn't pay you money but give you an IOU. So they do collect interest on it, but the main thing is for the buyer to sell their assets. Some of the REITs there. So if they sell it, then there'll be a big windfall for Keppel, because then they'll pay back this 4 billion. Then the second part of the story for Keppel is the transition that they're going. They are moving into more funds under management, mainly managing other people's money, and also an earn fee income and so forth. But that's a longer term story, because for that you have to, you got to earn a fee over funds under management. The amount is smaller, and also to earn the carry or the upside from having carry interest or the gains from all these funds, it takes a few years before these funds mature. But most of these are infrastructure assets, like your data centers or your power plants and so on. Next slide. So for Semicon, we think it's structurally positive for some of the companies here we'll discuss. But the chart here is just to show that electronics is not that high growth right now. I think you got that big bump in 2020, 2021 because of the pandemic, and all these stocks really surged. But if you move forward, like smartphones, you're looking at 2 to 3% growth. Likewise for PC and notebooks, and this includes AI expectations into it. So electronics is not a very high growth industry. I mean, that's the purpose of this chart. Next slide. But we move on to the individual names. For us, venture, we have a neutral. Near term, in the third quarter, we were just a bit worried of the strength of the ringgit. So ringgit in the third quarter spiked up, I think, almost 11%. So this could hurt earnings, because what it means is that most of ventures operations are in Malaysia. So this means that their ringgit wages is just, for the third quarter alone, just going to jump 10%. I mean, in very simplistic terms. And that we think could hurt margins. That's one thing that we're watching for in the third quarter. Meanwhile, we're neutral. They still pay a 5% dividend yield. So some still like it because of the yield. And you get the optionality, if electronics really turn up. For semicon names in Singapore, those that have momentum is, we think, is Franken and Grand Venture. So for Franken, is their big European lithography company. And the next growth driver for them is HBM. Likewise for Grand Venture, HBM means when you do AI chips from NVIDIA, you need memory, and you need the very fast, high bandwidth memory. Things like Micron and I guess even Samsung doing now. But this memory, they need equipment, and the equipment is one of Franken's customers. So that's where the growth is coming from. For UMS, we think second half might still be slow, because we think they are losing market share to a Malaysian competitor. And their new customer in Penang, the new plant is up, but the loading is quite slow. So UMS is probably more a 2025 story, which is not that far away anyway. But I guess the few quarters will still be weak. For AEM, they do have many new customers. They're looking at triple-digit million, probably maybe 100+ million of revenue for the new customer. But it may only mean it could just replace the existing, their number one customer, the one that's having issues now. So that could be a KIV again, and more of a 2025 story. For Nanofilm, they are actually making some impressive progress with a new Korean customer. I guess the largest smartphone maker. They are not only this is a new customer, but they are doing their latest model and the bigger fonts. Because for their other customers, see the big US smartphone guy, they are mainly only coating of buttons and so forth. But for this new customer, they are actually coating the whole enclosure, which is a bigger revenue per unit. But again, the transition, you still need to wait for the new US customer to pick up. But they are making headways into new customers. And the other big thing for NanoFilm is the equipment business is really down. So it's down like 40% this year. So any recovery will only be next year. So for Grand Venture, it's strong growth. And this is even before touching their 4 new front-end customers. But we think the recovery only in 2020. But we just think that it's expensive. But if you want earnings growth, momentum is probably we think Franken and Grand Venture in the results. Next slide. Move on to healthcare. So for healthcare, we have a neutral. I think after the pandemic, you saw the fallout, the earnings is down like 40%. We think they are also having some impact because the foreign patients are either flat or at best flat or most likely coming down, declining. Because we think they're being squeezed by their main competitor, IHH, which we can see the results are still very strong, about 20%. So we think all the high-end procedures is going to the linear competitor. And they're also burdened by China's startup losses. For Q&M, if you take a longer term view, it's actually quite interesting because they are actually they're starting to get incremental revenue from AI assisted. So basically what it means is that as a patient, when you go see the dentist, rather than get the dentist recommendation, you will get an AI evidence-based recommendation. It has started to provide some incremental revenue. That means patients will take that and then they will, the billing will increase or the revenue intensity will increase. So, but it will take time for it to really become really material. But we're starting to see some progress. For Hyphens, no stranger to the story. I think they are a small company, but they're building a brand, a global brand, regional brand from Ocean Health, Teraden, TDF. But that takes time. And for a small company, you invest on this, it's going to be a pull on your earnings in the near term. And it's a brand name and a franchise, and their strength is really also the ability to sell specialty products to the doctors, so that the pipeline of drugs is building up. But again, you probably knew a new drug that you introduce, you probably take 2 years before it ramps. So all this takes time to build, but it's only 7 times PE for a branded pharmaceutical company. Next slide. Oh yeah, okay. Anyway, this is just an update in case anyone, I think probably everyone knows this, but just to put it in charts. So for Iran, they produce like 4 million barrels of oil per day in roughly 100 or 96 million barrel per day kind of market. So any attack on the oil facility is going to be negative, but the second derivative or the secondary impact will be Iran has mentioned that they will attack Saudi facilities. So at risk is another 9 million of Saudi oil production plus their so-called 3 million spare capacity that they say they have. And the last point is probably it's no stranger in the drones have attacked Saudi's facilities before, especially this main facility called Abshak. So Abshak has a 7 million barrels of oil per day capacity. So if you see news that there's attack, then I think oil price is going to just skyrocket because the disruption to oil is real, I think, this time around. Next slide. Next slide. So I'll move on to our model portfolio. I noticed, so some of the yields that you see here, sorry, I think someone passed a question. Thanks for the question. But the yields here are all historical. So we don't take forward, we take historical just to make it easier. So that's why Darren's one is 8.5 because he's doing a forward dividend yield. So for the changes, we took out DBS when we put in UOB because we think on a relative sense, UOB will have a better will be benefit more from the lower interest rates, and the share price is a laggard compared to DBS almost 30%. We took out. We admittedly we were slow in sets, so we took we took out Singtel, which also gained about 30%. And we put in sets. So for sets, we think the momentum, especially third quarter earnings, will be very strong. With the repricing. So once you get a repricing, like Miao mentioned, it won't be just 1 quarter, it'll be the whole 4 quarters of benefit that you'll see year on year. So that's why we think it has more momentum compared to Singtel. So Singtel share price has run up. But we think this recent run out is because of the excitement over GPU as a service. Sorry, it's not in this table because one is out, we took it out, so we removed it. But we think any GPUs will come in only in 2026 first quarter calendar, because that's when their 64 megawatt plus capacity will be turned on. So I think in the near term, with the share price, we think might have overrun a little bit for Singtel. That's why we took it out. Next slide. This is just the historical performance. I think probably 10% up for the third quarter. Again, this is just for illustration. You may not repeat it because what we do is every quarter change, we just rebalance everything to 10% just for illustration, for ease of computation. Next slide. And conclusion, we think global growth is still slowing down, but it's not tipping over. No signs of a recession. And there's more global easing coming on. Since September, there have been 17 central banks that have cut interest rates, I mean, based on my own count. And there's now stimulus underway, including China. We overweight REITs, construction, transport services, and defense. Thanks. I think we'll move on to Q&A. Thanks, everyone.
Yeah. Thanks, Paul. Yeah, I think there's two questions for me. First one is, hi Glenn, other than the SGX, do banks benefit from market volatility? Yeah, we definitely do think so. That's why we put up that slide earlier, right, showing the VIX, which is the volatility index that we are looking at to compare against the bank's trading income. So the banks also do have a trading segment, right? So with higher volatility, there should be increased activity in trading. Hence, that's why we feel that there's a possibility, especially for going to the third quarter results, right? With what happened in August, that there could be a possibility for trading income to have even higher growth for the 3Q especially. And secondly, there's also a chance that there could be more hedging activity from their customers that should also benefit them as well. Yeah. I think there's one more for me about the US banks. Yeah, what can we expect from the upcoming US banks results with the JPM and Wells Fargo this Friday? Yeah, so for the US banks, I think the main point being is that how are they going to sort of react, to the rates. And I think for the US banks, they are, my opinion is that they are probably quite thankful, although on the outside it may not look like it, because their cost of funds had this like very slow but steady creep up, and then it was aggressively going upwards the last few quarters, where we saw, which is what ate into their net interest margins. Hence that's why their net interest margins declined quite steeply. Even though rates were high, you didn't expect that from a bank, right? They could be able to benefit from it. It's very different from Singapore, because Singapore, you only have so few local banks, right? There's not much competition. Even though, let's say if DBS doesn't give you good interest rates, you will still put your money with them, right? Because I think there's a trust factor as well. But for the US banks, it's slightly different. So they compete very aggressively among each other. Hence, for them to attract customers, to grow, they need to give higher rates, right? Because not another banks will give them higher rates. So with the lower rates, I think that will benefit their cost of funds. We could see net interest margins probably, hopefully, flatten out. It was on this decline for quite a few quarters. Secondly, what else would actually grow? It's their investment banking arms are all doing very well. I think JP Morgan has guided for like 20-30% growth for the next quarter and even for the year. So that's incredible. We'll probably see that across the board, not just for JP Morgan. So that'll be one of their big growth drivers. And last but not least, similar to Singapore's story, would be the loans growth. Loans growth will pick back up, and I think we'll probably be seeing a lot higher loans growth, and this will sort of offset that the net interest margin decline due to lower rates. But then because loans growth is coming back up, then we will see it sort of like balancing out the net interest income. So I think overall it could be quite mixed for all the banks, especially. Yeah, so hopefully that gives you a good preview to the US banks. Anyway, if you want to have more information, just throw it out there. On the 9th of October, I think, yeah, 9th at 7:30 p.m. We do have our US strategy and stock picks. Yeah, so join us there, and we'll be able to explain more on the. I'll be presenting as well on the US bank, so you can always ask me more questions on that day. Yeah, there'll be some slides on the preview as well as the review of the last quarter. Yeah. So hope you can join us on that day. Thanks. I'll hand you over to the rest of my colleagues.
Yeah, thanks, Glenn. Let me take on as well. Please explain with respect to the table you showed on REITs. Why is DPU for Escort companies negative when MPI is positive? Yeah, so there are many moving parts between the MPI line and the DPU line. So basically, for all of the REITs, like I mentioned when I was explaining the chart, is in between there's a finance expense. So, like for example, after the MPI, then you minus more finance expense. Basically, your DPU or distribution amount will be lower. So there's like more accounting. But in the case for Escort, they also did a fundraising, if you remember, in third quarter last year. So this, and on top, so basically for Escort, on top of the fact that the finance cost increased year on year, the asset base also they have more shares basically. So when the distributable income divided by a bigger base of more shares, then the DPU will be much lower. So that's why the Escort the MPI was up 12%, but the DPU was down like 8%. Yeah, Keppel DC, the impact wasn't that large. It was mainly high finance expense. Yeah, the Comel REIT question Paul answered already. So basically, yeah, one is historical, one is forward. Yeah, the one in my slide was forward, while the one Paul used was historical. Yeah, there's a question on Public Life REIT. I'll take a shot at it, and I think the question related to Paul, so I'll leave it there. The share price has increased drastically despite generally relatively low dividend question. Despite relatively low dividend returns compared to other REITs. What's your take? Yeah, so historically, Parkway Life REIT has always been trading at a very high price to NAV ratio of upwards of 1.5 times. So we think the reason is because of their solid Singapore hospitals, which is very unique, and there are no other REITs that have basically Singapore hospitals in there. The only other healthcare REIT is First REIT, which does not have any Singapore hospitals. They do have a couple of nursing homes, but yeah, it's not hospital. So Public Life REIT basically, I think investors are just pricing a premium on that based on the fact that they have Singapore hospitals. So at the current price, the dividend yield is only like 3.5%. So yeah, it's not trading. It is more trading like a share rather than a REIT at this point because of the low dividend yield. Yeah, so that is my tip for Public Life REIT. Yeah, there's why does FCT price remain weak? What is gearing situation? Yeah, so for FCT, their gearing is around 39%, so that's very healthy. The share price seems a bit weak today, specifically, mainly in my view, is because of the strong jobs report that came out Friday. So as a result, the yield also shot up, and the REIT saw a bit of selling off this morning. So yeah, that's I think this is just near term, but going forward, FCT, their portfolio is very resilient, very stable, like solid suburban malls with some decent positive rental reversions, 7-ish%. We expect that to remain for the rest of this year. So some good rental growth, and further upside is from the completion of T1. I'm not sure if you've been to Tampines 1. It's been refurbished, and basically the EI works have been completed. Yeah, so that will start to contribute fully, and that will definitely benefit FCT forward. Yeah, so that's our take. I think that's all. from here, hand over to Phillip. Thanks.
Thank you, Darren. I'll take over the OOE question. There's a question for sets. Wait, will the recent Chinese stimulus benefit? Will the Chinese government massive stimulus benefit sets? So the stimulus will benefit sets in certain degree. Like since they do have like a central location in China, in Tianjin. So government is not only supporting the stock market and housing market, but they're also actively providing loans to stimulate the economic growth. Yeah, so as mentioned, LPI is on the downward trajectory. Yeah, so we believe sets will be benefited from the cheap financing and also the active economic activities from the stimulus. And also like there's improved air traffic. We believe China will back to around like 90% of pre-COVID level, and currently is around 25% below pre-pandemic level. Yeah, so they'll improve back to around 90% of the pre-pandemic level by the year end. And in August 24, Chinese tourism in Singapore has already surpassed pre-COVID level by 2%. Yeah, so with the increasing air traffic demand, we believe this will benefit sets. And for OOE rate, why OOE rate is a buy call when dividend returning below market dividend yield for Singapore rates, and why OOE rate was chosen when ICR is 2.3, which is the lowest among those has been presented. Yeah, so OOE is a buy mainly because of the cheap discount to its net asset value. A dividend yield was shown just now. It's a forward dividend yield, which is based on our FY24 forecast. And DPU in FY24 will be diluted because of the increasing financing cost, and also OOE has shifted its management fee from like hybrid, which is cash plus units, to pure cash, 100% cash. Yeah, so that's why we anticipate DPU will drop this year, but again, it will stabilize next year. Firstly, because cost of debt is already on the downward trajectory, is already like lower compared to last year. Not only because like the Fed cut rate, but also because like they have improved credit rating. So like banks has lowered their margin. And for ICR, we do believe our cash position will be strengthened since they have planning to lower the cash management fee proportion. Yeah, lower from like 100% in cash. And also a lower interest rate, lower interest expense will also help to save them cash. Yeah, so with the positive outlook, and also the very steep discount to its net asset value. Yeah, that's why we have a buy recommendation for OOE. And update on 17 Life. Yeah, so on 17 Life, essentially is we believe they already have a turnaround from second quarter 24 onwards, since their operating metrics has already bottomed out, like such as MAU and also user retention ratio. And in second quarter 24, the operating income reversed from a loss in first quarter to a gain around like 1 million gain in second quarter. Yeah, so I believe our situation will change from second quarter onwards, since they already finished all the cost cutting from R&D and also lower the revenue sharing for streamers. And yeah, that's for their core business. For WeLever, it's still on the upward trajectory since they lowered the cost of skin for WeLevers. Yeah, so streamers active monthly user already tripled. Yeah, so revenue already tripled in first half 24. Yeah, and we believe like overall profit would increase to around like 5 million for WeLever. And also for the e-commerce, like they cut the live streaming business in Singapore and also the rest of Southeast Asia, excluding Taiwan, but they re-enter into Singapore with its live commerce. Yeah, and we believe this would increase like other revenue by around 30% this year. Yeah, that's all for me. I'll hand over to Paul for the rest of the question. Thank you.
I think there's an EV question. Does anyone think?
Yeah, thanks, Paul. I think there's a question here on tariffs. Does China EV tariff in Europe have any impact on Tesla? So the short answer is yes. So actually, over their second quarter earnings, they did mention margins were impacted a little bit by the EV tariffs. Although since then, I believe they've had some work through with the European Commission about obtaining either lower tariffs or, I guess, essentially lower tariffs. So it shouldn't be that significant of an impact. At the same time, they're also trying to shift some of the production. So actually, some of their deliveries, even though I believe in UK, they actually export out of China. So what they're actually trying to do is actually just try to export it from, I believe their Giga Berlin factory. I think the main reason why they do it is because of I believe is what side of the road that they drive on. So it's actually that is kind of how they are how Tesla is also circumventing these tariffs on China imports. Yeah, short answer is yes. Yeah, I think that's all for me. I'm gonna hand it back to you, Paul. Thank you.
Yeah, thanks. Let me just try to answer some. How do you see China firing more stimulus salvos after Golden Week? Yeah, I think after Golden Week, like we highlighted in the SSP, we think people will be watching for the Golden Week news. I don't think they will have much impact because of the stimulus. I don't think because the stock market up, everybody started spending more. But if there's any positive news, it can only be good because if it's weak, then they will just say that the impact is not there. But if there is some positive numbers coming up from the Golden Week, then I think maybe the shares can rally one more time. Then maybe there'll be some news of the government issuing the central government bonds. Then thereafter, like we highlighted, we were a bit cautious because we were coming towards the US elections. And once that happens, there is quite a big risk. If Trump does come in, then he'll immediately slap Trump. There'll be immediately sell down on Chinese stocks. I mean, that's our view before it can recover. So near term, and this is all liquidity flows. Yeah, so we just think the next 1 week still fine, maybe 2 weeks at most. Then we if there's some good news on the Golden Week sales, yeah, that's our own guess. I mean, it's because we're trying to predict where the flows are going. Yeah. Parkway Life, I think that was done by. Hi Paul, will you see better results from Propnex and APAC Realty second half since rates have been cut? Mayor good sales all weekend. Yeah, we've already forecasting a bit better because last year first half was very bad. But if you look at the July and August property sales, it's still down almost 60%. So this next 2 months is very critical. So they've only got 2 months to sell because after Hungry Ghost Festival, then before school holidays, you're talking about October and November to really sell. And we could help sentiment, but again, we've already forecasted better results because first half was really bad. The new home sales, but the surprise has been secondary. So secondary has held up better than expected. So even if there's good, so I knew just to come to the conclusion, even if there's good property sales, we are already forecasting that into our numbers. So we're expecting second half to be better than first half. So it is more or less within our expectations. But again, July and August still very bad. The new home sales down 60%. What's the growth driver for Wilmar? The stock seems strengthened. Yeah, we are actually quite positive on Wilmar. We think after so many months of a bit being negative, I think this time around almost all the stars are aligned for Wilmar. So the first one that we mentioned too in the SSP is India. So Wilmar has Adani Wilmar. So they in India, India just imposed duties on palm oil, imported palm oil. Obviously, it's not good for palm oil, but if you know how to time it well in inverted barrel and you have enough inventory, then I think maybe Adani Wilmar will do well. The second thing is the export duties from Indonesia has been cut. So that is a benefit for all the refineries in Indonesia because it will go direct to the bottom line. So in the past, when they export, they have to pay duty. Now the duty is disappeared. So instead, that benefit goes down to straight to their bottom line. So that's another positive. And I think palm oil price is up the 6-month high, if I'm not mistaken. So if I just didn't double check again, but that is another positive for Wilmar. And the third thing is that for Wilmar, I will show it next week, but the data shows that their soybean crushing, which is the other business in China, the two main business in China is soybean crushing. That means you buy soybean, you crush the meal, and then you sell it to the hog farmers. So the margins are actually improving, and hog prices are also climbing up. So their customer, which is the hog farmers, is healthier. And of course, the next one is just consumer, edible oil, if people are a bit more positive. So almost everything is doing well for Wilmar. Maybe sugar might be a bit down compared to last year. So it looks pretty good for them. But you may not see it in the third quarter results. You probably might see it mainly in the fourth quarter. But third quarter, you see some of it, I guess. Yeah. Because all this only happened in September, all these particular duty movements. Any view on Aztec, Innotech, and Grand Venture? Yeah, Grand Venture, we think will do well, I think. Yeah. I think they are growing even before getting the front-end customer. Aztec will be stable. Their customer is mainly Blink or Amazon, and I think we highlighted before. I mean, you've got Amazon, your customer. Amazon knows everybody's buying patterns, so they always have advantage. Innotech, I think it's supposed to be some data, their AI servers that they're assembling, if I'm not mistaken. But I think there was a bit of weakness in the first half results because of excess inventory. But I think maybe second half should be better because they're getting jobs from assembling these AI servers or GPU servers. If I'm not mistaken, I didn't go for their plant tour. Yeah. What do you think of UMS? Any price target? We don't have any specific price target, so we don't have fundamental coverage. This one I'll leave it to Zane to give you something. Hi, Paul, what's your view on Thai Bev IPO update? Good to buy. Yeah, I think it can only be good because they want to have a very high valuations for their beer co. I think they used to say 30 times, but I'm not sure they're going to do it. But even if it's 20 plus times, it's higher than their current share price. I think Thai Bev now is trying like 12, 13 times PE, if I'm not and also the second thing is that for Thai Bev, it will help deleverage. I think one of the problems, the overhang a bit is that the leverage is pretty high, so that will help. And the third thing is watch out. I think Thailand is going to implement stimulus, not the digital wallet thing, which I think not feasible. But they are going to implement a stimulus. If I'm not mistaken, they're doing it right now too. So I think Thai Bev should be better, and Vietnam is also performing better for the Sabeco. So I think Thai Bev is fine. Even without the IPO, I think the outlook looks positive for the next few months because of the macro conditions. Franken lithography, the biggest lithography maker is ASML. HBM, so HBM is mainly Teradyne, the missing link here that you mentioned, and Macron, Samsung. Yeah, so the missing link is that they don't sell directly, so their customer, I guess, is probably going to be Teradyne. So Teradyne builds all the testers for all this HBM memory. Yeah, and Teradyne is I think a similar customer between Franken and also Grand Venture. What's your view on Citron? Citron is a puzzle for me. I'm not sure. Take a peek of what thing. So some of the rumor, some of the speculation is that the investigations will come to a conclusion soon. Some say they'll be getting some contracts, which is expected because Petrobras or FP, there's Citron already guided they're going to get. There's possibly another 7 more vessels coming from Petrobras up to 2030, so roughly 1 a year. Some say the results should be good. I'll be a surprise, but anyway, that is the other speculation. And of course, oil price. I'm really not sure which is the right speculation to use, but this is all the 4 that I heard of. So I'm sorry if I don't have the right answer for you. The Citron benefit from oil price spike. Yeah, definitely. I think then if there's an oil price spike, of course, their customer, which is like Petrobras, all the oil majors will accelerate they'll put more budget, put more money to do oil exploration or oil production, and that will benefit. I mean, the ultimate one would be if someone really orders a rig from them, but I don't think that's going to happen. Most of them is FPSOs, which is production, like a floating refinery kind of thing for production of oil. I'll move on to the next one is John. Then what's the view on IX? Yeah, I think I get this. Let me try and get them to do a webinar. I will just try and ask them again. Really no change in our view. It's back to looking for licensing customers. But let me try and get them to do a webinar. Then you can just ask them directly. The sudden surge of China stocks last week sustainable. We still think maybe 1 or 2 more weeks. Then I'll be very cautious. Like even Yanlong, I think Yanlong has really doubled the share price. So again, there's no news. I mean, this is just on expectations, and we are a bit fundamentally. We think the recovery will happen, but will be slow. I think this is through a wealth effect. That means the stock market up, bond markets are up, then you benefit the consumer indirectly because they become richer. But you still need the income effect. So people's income still need to grow. The jobs need to be there. So that is secondary. But again, you're playing stock market, right? It's based on expectations. We also think a lot of it is underweight, the whole market underweight. Then now they're just pushing up the thing. So to maintain this rally, you need news flow. So the news, like we mentioned, is probably Golden Week, some news on bonds, which could carry the next 1 to 2 weeks, and that's it. Has the reckoned US dollar bottom? My own view, for what it's worth, pick it with a pinch of salt, is actually the worrying thing I have is that even though the Fed cut rates, right, and even since the so-called power pivot in August, actually interest rates in the US actually went up. So the 10-year treasury actually climbed. So that's a bit worrying. That means imagine the Fed cut rates, but the interest rate go up. That means the treasury bond yields go up. So what this means is that people are concerned about inflation in the US, or they're concerned there's a lot of, because US is running a 2 trillion fiscal deficit. So the market may not be able to absorb so much bonds. So this might be a bit negative for US dollar. Yeah, again, this is my own thing about but funny thing is, although interest rate cut, but the 10-year bond you keep rising. So that's a bit scary actually. I will leave it to the rest because all REITs and for Darren and Jonathan. Yeah, thanks.
Yeah, thanks, Paul. Maybe I'll take this one question. It says here, hi, Jonathan. Any key takeaways from MetaConnect? So actually, when I watched it, the key thing that was interesting to me were 2 things. Firstly, was your AR, the Ray-Bans AR sunglasses, well, glasses in general. I think that was quite interesting. Plus the fact that it's essentially sold out. I think there's seen quite a bit of demand for that kind of hardware. The other very interesting thing is their Quest 3S headset, which is their AR VR headset. It's even lower price with better specs. So it's coming in at $300, which is less than 10% of what Apple's Vision Pro is retailing for. But the overall theme is just essentially Meta showcasing their new products, specifically around the Metaverse AR VR. So all in all, it's quite an interesting event. But it's more, I guess, more marketing than anything else. I think it does give some inclination as to how maybe that there is a little bit of demand for some of its hardware, but this, in the grand scheme of things, revenue that they generate from hardware is still extremely small. At the same time, production is also fairly limited. So it's not like they are mass production, millions of units. They only have like 10,000 units or less than that of the Ray-Bans, and so yeah, it's more of giving you an idea of what trajectory they're on for the kind of metaverse hardware that they've been harping on for the last 5 or so years. Yeah, so hope that helps. I don't think obviously the stock prices continue to do very well. I think partly because they continue to have these kind of events which showcase at least some progress and in terms of what they're trying to do for the future. Yeah, I don't think there's any more questions for me. I'm gonna hand it back to Darren. Thanks.
Yeah, thanks, John. Yeah, so first, as REIT prices have been dropping over the past few days despite the drop in interest rates by Fed users. Yeah, so first of all, the run up to the Fed cut in September, the REIT share price really jumped by quite significantly, by quite a significant amount, by almost 10% or even more. So it is part and parcel of a healthy stock market, I guess, that the share price will not just keep increasing, and there are some retracements and up and downs. The share price can't be just up in one straight line, right? So it is part and parcel of a healthy stock market. And like I mentioned, just today there's a bit of sell down. Yeah, in my view, is probably because of the spike in the 10-year yields because of the strong jobs report. So that's my answer for that. What is the breakdown of US SG portfolio for Mapletree Industrial? Do you expect the US industrial segment to be strong? What do you expect from the upcoming results? Yeah, so Mapletree Industrial, they have about 46.9% of the portfolio in North American data centers, and the rest mainly in Singapore, 48%, but the Singapore data center exposure for Mapletree Industrial is just 3.2%. Yeah, so for basically for the occupancy, we expect that the US data center portfolio occupancy will pick up as some of the vacant space gets filled up. Yeah, so so that is our expectations. The occupancy will start to fill up over the next 2 quarters for the US portfolio. So now it's about 88% for the NA portfolio. Yeah, the Osaka data center remains 100%. Singapore's portfolio is about 94%. Yeah, so the pickup in occupancy, that will help to bring the portfolio rent occupancy higher. With the pickup in occupancy in the North American data center portfolio. Yeah, so the rental reversions was still quite healthy at high single digit for total portfolio value for the first quarter. So I think it's a similar mid to high single digit reversions for the portfolio. Ascendas Business Park segment. Can you give a breakdown of this park logistic data center? What do you expect for occupancy level? Yeah, so for Ascendas, the breakdown give me a second, I missed this slide. Yeah, so the breakdown for Ascendas property, yeah, 64% of it is in Singapore, 12% is in US, 14% in Australia, and 10% in UK. Yeah, so for business park, they are quite heavy. 45% of their portfolios in business parks, 27% logistics, and the remaining 28% is in data centers and the traditional industrial properties. So yeah, so that's a breakdown. What do you expect the occupancy level? Yeah, we expect occupancy to remain relatively stable. Yeah, so not much movement for their portfolio. Yeah, so that's my expectation. So occupancy we expect to remain around 93% for this quarter. Yeah, I hope that answers the question. Yeah, and I also expect occupancy to remain around 93% level because not many leases are up for renewal this year, for the rest of this year, so only about 6.8%. Yeah, so yeah, that answers that question. So yeah, it's time to hand over to Zane for the technicals. Yeah, thanks, Zane.
Thanks, Darren. I'll share my screen to start on the TA. Okay, yeah. So first question is Yang Zijiang Financial. I think there is still some room for upside. I think because price actually went up over here and it did a consolidation between like 39 cents to 40 cents area. And currently we're seeing price break above is the highs of last week at 40 cents, 40.5 cents. So I think we could still see price move higher. Next key resistance level, I would think is probably around 43.5 cents to 44 cents area. Previously, a level in June 2022. Afterwards, then we could maybe see like 47 cents to 48 cents area. So overall momentum, I think is still quite good over here recently. The next question is on Bank of China. Bank of China, I think is still looking good as well. Still holding the breakout of this downwards resistance line in blue, following a retest, some consolidation recently, and today price is above the resistance level of 388. So I think as long as this holds, we could still see some further upside. Maybe next level at $4, and maybe 4.15 as well. So yeah. And next one is on Beijing Jingle Clean Energy. So for this, I think the trend is still holding well. Price last week broke above the resistance of 205 over here. They are back test and still holding as support. Afterwards, we're still seeing new high. So momentum is still very strong. I think we could still see higher highs ahead as well. Next key resistance level, I think, could be closer to about 240, which was a high back in October 2021. Okay, then there's a question on TA for sets. Okay, for sets, I think it's still the uptrend is still holding up well. Recently, we had a consolidation over here between about 358 to about 373, and then it managed to break out the resistance on Thursday last week. So I think with that, as long as price continue to hold above this breakout, we could still see some continuation in the bullish trend. Next resistance level could be closer to about $4, which is the psychological level as well as a previous swing high back in August 2022. Okay, the next question is on Singtel and as well as China Aviation Oil. For Singtel, I think currently it's a bit still undergoing a pullback over here. Price is still you can see it's still trading below the short-term moving averages of the 5 and 10-day. As well as last week we see that it broke below this 320 support level, recent support level as well. So I think you could see a bit of slight further pullback, maybe towards this next level at around 310 to about 313 area, which was previous resistance turn support level. So I think over here, price should get some support for a bounce afterwards and maybe some consolidation. And so I think for Singtel overall short term wise, maybe some slight further pullback to consolidation. And then for China Aviation Oil, I think uptrend is still the bullish momentum is still intact over here since the breakout of 90 cents. Price did a slight consolidation. Resistance last week was 93.5 cents. Today we had a breakout above it again. I think I see continuation of this bullish trend towards next resistance level at around 98 to 98.5 cents level, followed by maybe $1 and $1.02 afterwards. Okay, the next question is on. Okay, there's a question on UMS. So for UMS, I think looks like some consolidation currently. There's still some resistance at between 108 to about 110 area. Over here, price is just consolidating. But positive is that price is over here this stretch since the recovery back above $1.01 level. Price is holding a series of higher lows. So if it can hold continue to hold these higher lows, could see maybe a breakout upwards. If it does break out above 110, we could see maybe next level at 114, 115 afterwards. Yeah. But for now, it looks like still some consolidation between like 106 to about 110 area. Okay, then here on the three local banks. First up, DBS. So at DBS, I think currently seeing some slight rebound. Price did a sideways consolidation at around $38 level, and currently seeing some slight rebound. I would say Yeah, probably some resistance now around 38.80 to about $39 area. And maybe we could see some consolidation again in the near term. And for UOB, UOB went back to retest this previous resistance at 31.80, and currently it looks like some slight bounce, but I will expect with some near-term resistance around 32.30 to about 32.60 area over here. So we have some consolidation in the near term as well. Yeah, then for OCBC, something similar as well. I think currently pull back to a previous resistance. So this was at 14.80. So I think some bounce in the very short term, but some resistance ahead still around 15, close to 15.15 to about 15.20 area. So maybe some consolidation afterwards as well. Yeah, for all three local banks. Okay, then the next question is on Silver Lake, Q&M, and ComfortDelGro. For Silver Lake, I think for now nothing too much. Is still got a consolidation. It's just at a lower level since below its 37 cents level. So probably just around the 36 cents mark. And for Q&M, I think Q&M still the same, still holding in the range over here. Resistance still around 28.5 cents to 29 cents level. Support probably around this 27 cents, 27.5 cents here. So I think still some consolidation for now. For ComfortDelGro, some slight looks like some slight consolidation recently. Some resistance at 150, 153 area over here, some pullback. I will expect price to hold some support around 145 to 147 this area over here. So I will expect some slight consolidation in the near term. Okay, then there's also a question on Aztec as well as Franklin. Okay, for Aztec, I think looks like perhaps some consolidation for time being at a resistance of $1.02. Price is trading sideways, so I would expect some near-term sideways with support around $1. And current resistance is about 102 to 104 area. And then for Franklin, looks like still some sideways consolidation in progress. And currently some resistance about 137, 138, or support is likely to hold at 130, 131 area. So I think for now some range consolidation in progress. Okay, then back to some Hong Kong counters. First one 9888, which is Baidu. So for Baidu, I think looks like a bit of a sideways for now. After hitting some resistance levels like 112 to as well as close to 120. Look like some consolidation, but price is still holding the 5-day moving average as a support. So as long as it still holds above it, we could see maybe a retest of this highs again, close to 119, 120. Then currently some support at around 105, 106 level. Yeah. The next question is on JD 9618. For JD, also some consolidation at a resistance level 184, 185. Yeah, but it's still holding above the 5-day moving average. So you could see maybe a retest of the recent highs around 190 to 192 again. Yeah. And for now, short-term support is around this recent swing low dip around 160, 165, 167 about it. Okay, then for Alibaba, also similar. Some sideways after hitting resistance around 116 about there. So for now, yeah, we could see a retest of the highs around 118, 119 if it holds a 5-day moving average. If not, near-term support-wise, probably around 106, 107, the recent lows. Then for Ping An Insurance, Ping An Insurance one a bit stronger than the three mentioned earlier on. Yeah, we see this bullish engulfing over here. Today we made a new high above the resistance of 58. Yeah, so I think we could still see new higher highs ahead. See where's the next possible resistance. Next resistance area could be closer to about 62 to about 64 about there. Yeah, for Ping An Insurance. Okay, then there's a question on IJM listed on Bursa. Well, IJM, I think we're still seeing some weakness in terms of the overall trend wise. It's still in a bit of a downtrend since middle of July. Price has been the key support is still at around 286 over here, but price has been forming lower highs along the way, as well as the last week of September over here, price did a retest of price support at 315 turn resistance and came back down. So I still expect some weakness in price, possible breakdown of this support, 285 to trend lower towards next support levels at 260 to about 270 over here. And United and BRC. For your PenU, I think nothing much, still like some sideways consolidation for the time being. Resistance still at 53 cents, support is around 50 cents area. So yeah, still some sideways. BRC is slightly stronger. BRC, yeah, still recently after this consolidation managed to break above $2.31 resistance and continuing the trend of higher highs and higher lows over here. So I think we could still see some upside in terms of price to try to retest the previous resistance close to 240 to 244 area in middle of July this year. And there's also a question on, I think it's SMCI, super micro computer. Yeah, for SMCI, I think price is currently just holding in a bit of a range. The key support is around 39.50 about there, and the resistance around 47. So use some range bound keys for price to hold this support to continue this range. If not, if there's a breakdown, then I think we could still see it maybe go towards the lower levels like $31, $32 previous range consolidation resistance back last year. Okay, then there's a question on AIA. So for AIA, I think looks like some sideways consolidation for the time being at a resistance level of 72 to 74. But it's as long as it's still holding above the 5-day moving average as well as this horizontal level at 72, I think there could be still some potential for upside if we manage to break above the 74, 75 level. Next resistance level could be at around 79 to $80 level, which was the highest back in June last year. And then there's a question on Yenlot, Zixin, and Prime US REIT. Okay, for Yenlot, I think price is rallied a lot. Currently, it's around 84 cents, which was this previous horizontal level over here back in May to June last year. So it is currently at that level. If we can continue to clear this resistance, the next level it could go on to is around 90 cents to 93 cents area. Back over here, April to May last year. Yeah. So still very strong momentum currently for Yenlot. Yeah, then for Zixin, it's also very strong momentum, especially last Friday, price broke out of this gradual uptrend channel it was trading in on high volume as well as, price jumped a lot. Currently it tested a level at around around close to 214 is the level. So some resistance from there, but you can clear again. Next resistance level to look at is closer to about 224 level. Yeah, for prime US REIT, some slight weakness, but I think it should get some support from current level. So price actually gonna break above this 90.5 cents level over here, back in middle of September last month, but then subsequently reverse back down and we're currently seeing some weakness. But is back to a previous support level over here, which was around 17, close to 17 cents. Which was this support level as well as here as well. So I expect support to hold over here for the short term and do some rebound towards near-term resistance close to about 18.3 cents to about 18.7 cents area for prime. And then there's also questions for CLI and Capital Land Commercial Trust. Okay, for CLI, I think price trend broke above this $3 level, currently doing some sideways consolidation. So as long as price is able to hold above this breakout of $3, I think it's still bullish trend is still intact. The next key resistance level afterwards will probably be around close to 328, 330, the highest back in June to July last year. So look at some consolidation currently for CLI. Okay, then for CI, I think they are referring to CICT, right? So for CICT, I think the uptrend is still, in fact, I think it's trading in this uptrend channel over here in blue. Some consolidation currently, support is likely to be at this 208 level, which is calling the horizontal support as well as the channel support. So if you can manage to break above the resistance of this 216, then maybe you could see some side towards like 220. There's a question between 3115 and 2800, which chart ETF shows better growth trajectory? I'll do a comparison. 3115 is the this iShares Core Hang Seng Index ETF. Yeah, and I'll do a comparison with 2800. 2800 is the Tracker Fund Hong Kong ETF. That's why in general they are actually quite similar. They move in generally like the same in tandem lah. So I think I would say probably nothing too different. But for 3115 looks like it hit another level today around 85. Potential upside we could see maybe it's like closer to $90. So that's maybe about 4 to 5% upside mix. And for 2800, it's the next level for it will be closer to maybe about $25. So that's like about 5 to 6 maybe upside from current level. So maybe 2800 will have a maybe slightly higher growth trajectory, okay, say for the time being. And then I also see a question, will there be TA tonight? Yes, there's a TA session tonight for the US market, 8 p.m. to 9:15 p.m. Yeah, so feel free to attend if you are free. Thanks. Okay, then I'll move some of the US questions. First up is Tesla. So for Tesla, I think some slight pullback, but overall the short-term uptrend over here is still intact. The price is still holding above this upward support line still seeing this trend of higher highs and higher lows. So some rebound on Friday. So as long as price is still above about 242 over here, which is also this resistance breakout previously in middle of September, I think we could maybe see a price bounce towards the recent resistance above 260. For AMD, I think the recent uptrend is still intact as well. Price broke above this resistance at 162, did a back test and found support. Also at this prior resistance of 159 area. And currently there was a rebound back above on Friday. So I expect price to go higher to actually fill this price gap over here and test the previous support breakdown at around 170, 178, 179 level next. And then for ARM, ARM I think is slightly weaker, but overall it's still holding up above the prior resistance of 135. Still, it's just consolidating in the range over here. So as long as this 135 level, if continues to hold, we could maybe see a bounce back to the range resistance closer to about 149 to 152 area. And for Qualcomm, also something similar. It's just consolidating in the range over here, but some positive signs is that the support over here at 165, 166 is still holding up, which was this previous slight resistance over here. So some of these levels can hold. We could still see maybe price test 174, 175 resistance of this range consolidation. Then for TSM, is also positive. Price broke out above the 175 resistance, still a back test still holding as support and rebounded off. So I think we could still see maybe price retest the recent highs at 189, 190. There's also some resistance next at 192 as well. Okay, I'll move on to some of the US banks. This one, Bank of America. Bank of America looks like some range consolidation for the time being. Mostly between 38, about 38.40 to about $40.80. So I think nothing much is still in this range consolidation currently. And then for Citigroup, also quite similar, slightly stronger over here, with this higher lows over here recently at $60.80. So if price can break above the resistance over here at 63, then maybe we could see some further upside towards the next resistance at 65.30 for Citigroup. And then for Wells Fargo, also kind of a bit of a consolidation recently, but we could see maybe price go up slightly higher towards the 58, 59 resistance over here, which is this swing high, start of September, as well as this downwards resistance line in blue. Okay, then for JP Morgan, also in a bit of a consolidation recently, price just kept between 203 to about 212, 213. So you can still in a bit of a consolidation, you can break above the 212, 213 level. Maybe we could see it test 217, 218 next. And then for US Bancorp, I think also in a bit of a consolidation right now, just between about 43.60 to about 45.80 over there. So I think nothing too much for the time being. Then price is holding along this upward support line too as well. Okay, I'll do just one last one on BK, which is Bank of New York Mellon. So for this, it's one of the strongest, I think, over here. Price is currently doing a bit of a consolidation as well, holding support at this level at around 70.50 the meanwhile resistance is this recent highs close to 73. So I think some consolidation for now. In general, for the banks, looks like some sideways consolidation is going on. Yeah, I think that yeah, that's all from me. I'll hand back the time to my colleagues for any other questions. Thanks.
Okay, yeah, thanks, Zane. So we'd like to thank everyone for your time. And also someone mentioned that there was an error in the Semiconductor industry's target price. Yeah, that's totally right. There's an error on my part. The Semiconductor industry's target price is 627, not the $5. So yeah, so sorry for the error. Thanks everyone for your time, and hope everyone have a good week ahead. And apologies if you've already heard of this in our SSP, because we usually replicate it. That means after every Saturday. So next Monday, we'll also talk about the US strategy, a summarized version. With that, thanks everyone. Have a good week ahead, and thank you for all your time and your questions. Bye-bye.